Let me answer that in parts. My experience has been that in precious metals bull markets, gold leads. And when gold's momentum attracts the generalist investor into the space, leadership transfers to silver. Whether we're there or not, I don't know. What I do know is you won't need to tell me when it occurred. they're usually pretty dramatic events. I've seen them happen 3 times before in my life. And you don't need a weatherman to tell you which way the wind blowing when that happens. As to a silver squeeze, I am not one of those who believes that there's been an ongoing conspiracy to depress the price of silver over time. I worked for great big financial institutions, and the idea that they would take a negative carry, a short position, over 10 years or 12 years, which affected quarterly cash bonuses, the probability of that occurring is nil. Wouldn't happen. Markets, all markets, are manipulated in the short term, and they're manipulated in whatever direction is easier to manipulate. For 40 years, you have manipulated silver markets down because that was their natural direction. I remember the 1970s when trading desks would manipulate the price of silver up because that was the easiest direction. The manipulation takes place because the futures markets, the paper markets, often trade 200 times the available silver to cover on a daily basis. They're much more liquid. So the game works like this. A short syndicate gets involved over the last 40 years short in the futures market. 6-year duration, 12-month duration, 24-month duration, that kind of thing. And they get what would be for you and I massively short. $2 billion short, $3 billion short, in a market where the nominal value of the positions is $400 billion. And then they borrow $50 or $60 million worth of bullion, and they pound it into the market physically at whatever point in time the market has the least volume.
Right.
And they use the impact of the physical market on the futures market to cover their shorts and pay off their physical loss. I mean, you see it happen time and time and time again.
It's no
I don't
lose.
think that there's any evidence that supports long-term price manipulation. I think that there's an aggregate of short-term price manipulations. The Eurobond market has been manipulated. The Euro market's been manipulated. The U.S. Treasury market's been manipulated. If you can manipulate markets that are that big, the silver market's a piece of cake. What'll change, Kerry, is that the easiest way to manipulate the market is going to go from down to up. People who are involved in complex hedges in the silver market, I think, are going to get massacred. I think they're in for some truly religious experiences, to the extent that a short position on silver that has been put in place by algorithms that are looking at silver markets over the last 40 years, those leverage guys are really, truly in for a world of hurt. Long-term capital management worked until it didn't. It was a convergence trade, but the convergence trade wasn't set up for a third standard deviation anomaly. And I think the silver market is going to see a third standard deviation anomaly, which means that the people who are using silver as an unhedged corollary to some economic bet, and they're doing it from algorithms that are based on 40 years of trading history, they aren't prepared for a hiccup, and they're going to get a hiccup, to be honest with you. $35 billion is a lot to you and me, but the notional value of derivatives is more like $5 trillion. I'm not so concerned about that. I'm much more concerned about things like unfunded entitlement liabilities and the imbalance between the nominal and the real interest rates. If you want me to scare your audience, Kerry, I can really, truly do that. I'm less concerned about the impact on Wall Street and the derivatives markets by a silver short. I think it'll be, I think there's probably a couple of quantitative hedge funds that'll go broke. Good riddance.
No one cares about them anyway.
Yeah. But, the derivatives market is truly vast. There are other counterparty scenarios that scare me a lot more. If Ma's and Pa's in the United States that own high-yield ETFs, junk bond ETFs, get a whiff of the beginnings of a credit crisis like they did in 2008 around real estate, and they go to sell those high-yield ETFs, the ETFs are extremely liquid. They trade billions of dollars a day, but they're comprised of assets that are totally illiquid.
Yes.
If they redeem the ETF and the manager has to sell the bonds and can't, now that's a scenario that's truly scary. Carrie, in shows like yours, where there's live Q&A, I've talked to investors that held high-yield ETFs that didn't understand that the assets were comprised of junk bonds. They just looked at the cover yield, not how the yield was generated. When I was a younger man, I wasn't a young man, but in the 80s, I was pretty active in the high-yield credit market because I understand how to read bond covenants.
Let me answer that in parts, because I think people misunderstand not only how silver behaves, but why it behaves the way it does. My experience, and it's fairly extensive after 5 decades in the resource markets, is that in precious metals bull markets, gold always leads. It's the sentinel. It's the sober money, the capital preservation vehicle. But once gold's momentum attracts the attention of generalist investors, the folks who don't follow Kitco or listen to mining podcasts, then leadership transfers to silver. And that's when things get really exciting. Whether we're at that pivot point right now, I don't know. I suspect we're close. But I do know this. When it happens, you won't need me to tell you. You won't need a weatherman to know which way the wind is blowing. When silver gets hot, it gets volcanic. I've seen it happen 3 times in my life, and it's a sight to behold. These are not subtle transitions. These are market ruptures. Silver doesn't tiptoe, it stampedes. Now, as to whether there's some deep state conspiracy to suppress silver prices, I'm not a subscriber to the tinfoil variety of that argument. I work for large financial institutions. The notion that some trader would take a multi-billion-dollar short position over 10 or 12 years, fully knowing it would negatively impact his quarterly bonus? Laughable. That's not how human incentives work. Wall Street is many things, but it is not long-suffering. That said, manipulation? Of course there's manipulation. All markets are manipulated in the short term. They are manipulated in the direction that is easiest to manipulate. It's about liquidity. For 40 years, silver's been in a downtrend. So when it came time to nudge the market, it was easiest to manipulate it down. That's simply the path of least resistance. I remember the 1970s. In that decade, trading desks were manipulating silver up. Why? Because that was the direction of least resistance. It wasn't ideology, it was convenience. What changes the game is this. The direction of easiest manipulation is changing, from down to up. That's where we are. The short side games are becoming harder to sustain, and the price action is breaking out. You're already seeing these little anomalies where silver gaps up, seemingly without news, and the bid depth disappears. The mechanics of this are pretty straightforward. The futures markets, these paper markets, often trade 200 times the amount of physical silver that actually exists on any given day. 200 times. So if I'm running a short syndicate and I want to profit, here's the playbook. I short the paper market. Let's say I go $2 or $3 billion short, which sounds like a lot until you realize the nominal volume is around $400 billion. Then I borrow $50 or $60 million worth of physical silver, and at the moment of least liquidity, say a Thursday morning at 3 a.m. in London, I dump the physical into the market. That drives down the futures, and I close out my shorts at a profit. The physical loss? Who cares? It's peanuts. That, friends, is how the sausage is made. But what happens when it stops working? Here's where things get interesting. These algorithmic hedge funds that have been operating based on 40 years of downtrend data, they're not ready for what's coming. They've built their risk models assuming silver is just a sleepy metal that never behaves irrationally. So when silver goes non-linear, and it will, these guys are going to get clobbered. Third standard deviation anomaly, wiped off the map. Long-term capital management worked until it didn't. It was a convergence trade. It relied on normal spreads. But when that third deviation event hit, the entire thing collapsed. That's what's coming in silver. Except this time, the people involved are even more leveraged, even more opaque, and even more reliant on models built for a different world. Now let me scare your audience a little more. You think silver derivatives are bad? Try junk bond ETFs. You see, $35 billion in silver derivatives is a lot to you and me, but in the grand casino of finance, it's a pittance. The notional value of derivatives is around $5 trillion. But here's what really keeps me up at night. The mismatch between liquidity in ETFs and the illiquidity of their underlying assets. When Mo and Pa Kettle in Kansas start to get nervous, say there's a headline about a credit crisis, and they try to redeem their high-yield bond ETFs, they'll find something troubling. The ETF itself is liquid. It trades billions of dollars a day. But the bonds it holds, junk, illiquid, sometimes untradeable. If enough redemptions come in, the ETF manager has to sell something. But there's nothing to sell. It's like trying to withdraw water from a dry well. And then we have a situation like 2008, but potentially worse.
Frankly, I'd buy more knowledge. I know that's not the right answer, but your best asset at age 30 is compounding your knowledge and working on your reputation. I suspect that what an investor might do, assuming they have no other assets, looking at the next 10 years, is to begin to save systematically and save probably half of what you save in gold. I say that not because gold will necessarily outperform other assets, but I think that over the next 10 years, the purchasing power of the US dollar will decline by 75%, and that gold will maintain at least its nominal purchasing power, which means that it is a high probability savings instrument. That's a boring answer. I'm tempted to say that a 30-year-old who believes that he or she will be able to increase their disposable income over 10 years, if they're looking at investments simply as investments, should consider buying ExxonMobil. I would agree with that completely. Knowledge is an asset. Well, you can lose it, but it can't be stolen. It can't be taxed. The fruits can be taxed. And your reputation, the same. What 30-year-olds need to focus on is the group of people they choose to be their community, because you become the sum of your friends. Your reputation, because if you lose it, it's very difficult to rebuild it. And your knowledge. All the risks that you face, Carrie, probably are manageable if you manage the risk that's to the left of your right ear and to the right of your left ear. Well, it's important to understand that the Green New Deal wasn't really about environment. Let's get that out of the way. And I also need to say I'm no particular fan of Trump. But I do note that he has been effective at rescinding executive decrees by prior administrations. And I have noticed myself a real change in the politics of the regulatory agencies, which means frequently in the regulatory agencies, there was a belief at the staff level that resource projects should go ahead. But the politics of the agency were such has really competent technical people working there.
Oh, yeah.
They've been hidden well for 20 years, but they're there. Now there is an incentive within the organization to get stuff done. They can use the knowledge that they have in the agency to complete the regulatory process in a responsible manner. It's further to what you say, Carrie. Mining, looked at empirically, is an efficient use of land. You generate an awful lot of economic activity and an awful lot of consumer utility by despoiling a very small piece of earth. The Resolution copper mine in Arizona, when it's built after 27 years of permitting, will have substantially less environmental disturbance than one golf course. Golf courses are green, and people like to play on them. So they're regarded as not being environmentally deleterious. But if you have a monoculture, which is to say grass, in a riparian area, the truth is that they're environmentally extremely dangerous. It's important to look at the concept of environmental degradation from an empirical, technical lens as opposed to an emotional and narrative lens. And I think what Mr. Trump has been able to do at the regulatory agencies is allow them to return to empirical rather than political or narrative analysis.
Now let's talk gold, because I think people still, after everything, don't really understand why gold matters. It's not because it's shiny. It's not because it's rare, it's because it's nobody else's liability. That single attribute makes gold unique in a world saturated with IOUs and systemic leverage. You can't print it, you can't default on it, and you can't dilute it with a central bank press conference. If you're holding dollars, you're holding someone else's promise. Same for bonds, same for most ETFs. Gold, by contrast, is a self-contained store of value. It doesn't generate cash flow, but it doesn't require counterparty performance either. When the music stops, and it always does, gold is what gets settled to. Now, the great irony here is that for decades, central banks treated gold like an embarrassment, a relic. Ben Bernanke literally called it tradition in one of the most unintentionally revealing moments in central banking history. But since 2010, central banks have been net buyers of gold. China, India, Russia, they've been hoarding it while telling the public that fiat is the future. It's the monetary equivalent of telling your kids to eat soy burgers while secretly grilling a ribeye in the garage. China, by the way, is playing chess while we're playing Candy Crush. They're importing physical gold hand over fist. Their reported reserves are a rounding error compared to what they actually hold off balance sheet. They understand what's coming. They're preparing for a reset in trade settlement. Maybe not tomorrow, but sooner than the market expects. The US, meanwhile, is still pushing the dollar like it's 1995. But the Triffin dilemma doesn't care about our nostalgia. You can't run persistent deficits forever and maintain reserve currency status. Eventually, the system revolts. Now, let me tell you something a lot of your viewers might not know. There are $33 trillion in US Treasuries outstanding, but the buyers have vanished. Foreign central banks aren't accumulating anymore. Domestic institutions are full, and retail, they're just not that into it, which means we're now financing our own debt with printed money. That's not a long-term strategy, that's the beginning of a spiral. When the next recession hits, and one always does, we're going to see renewed attempts at stimulus. Not just fiscal, but monetary. The Fed will cut, the Treasury will spend, and bond yields, real yields, will go even more negative. In that world, what rational saver wants to hold fiat? That's when gold becomes not just a hedge, but a destination. And here's the kicker. The gold price doesn't have to rise dramatically in real terms to generate extraordinary nominal returns in mining equities. If the gold price merely holds flat while operating costs fall, through energy deflation, automation, or FX rebalancing, you get margin expansion. That's where the magic happens. Because miners are leveraged to gold by operating margin, not just by ounces. But you have to know what you're buying. Most people don't. Most people go to Reddit or some YouTube channel, they see a guy with a cowboy hat talking about a lithium deal in Peru, and they throw money at it. They don't read the 43-101. They don't look at drill core. They don't verify the metallurgy. They just assume that because lithium is hot and Peru has mountains, the stock should go to the moon. That's not investing. That's donating. I always say, if you want to speculate, go ahead, but do it intelligently. Understand that 80% of junior miners are lifestyle companies. They exist to fund salaries, not shareholder value. They'll change commodity focus faster than a TikTok trend. One day they're in uranium, next day it's graphite, then gold, then helium, and now, wait for it, rare earths from coal tailings. It's comedy if you're not holding the bag. I'll let you in on a little secret. 90% of the wealth I've made in this sector came from 5% of my positions. That's the nature of exploration. You're funding negative net present value holes in the ground in the hope that one turns into a tier 1 discovery. When it happens, it's glorious. When it doesn't, it's tuition. So here's the mental model I suggest to viewers. Allocate capital the same way venture capitalists do. Take 10 shots, expect 6 to fail, 3 to break even or provide moderate returns, and 1 to go 20x. That's your math. But you have to know what you're betting on. Do you know the burn rate, the cash in treasury, the expiry schedule on the warrants, the geology, the jurisdictional risk? If not, you're not speculating. You're gambling. And if you're gambling, at least take the casino's comps. Now let's talk silver, because it's the wild cousin of gold. Gold is the tuxedo metal. Silver is the biker jacket. Volatile, aggressive, and deeply misunderstood. The silver market is tiny. I mean absurdly small. The entire global silver production in a year, about 1 billion ounces, is worth maybe $25 billion at today's prices. That's the market cap of a mid-tier tech stock. So it doesn't take much capital flow to create disproportionate price movement. And here's where it gets fascinating. Most silver is produced as a byproduct of other metals: lead, zinc, copper, even gold. So if those mines shut down, silver supply drops regardless of silver price. That creates scarcity dynamics that no algorithm can model. Add to that the reality that silver is both a monetary and industrial metal, and you get a Jekyll and Hyde price profile. In bull markets, it lags gold until it doesn't. Then it leaps like a junkyard dog. In 2010, it ran from $9 to $49 in less than 2 years. And it did that while ETFs like SELV were swallowing physical ounces like a black hole. Now imagine what happens this time when not just ETFs, but sovereign buyers and BRICS currencies come for the float. That's not a melt-up. That's a detonation. But don't take my word for it. Just watch the commercial trader positioning on the COMEX. The open interest is drying up. The shorts are covering. The bulls are accumulating. And yet the price isn't moving. Yet. That's not bearish. That's coiling. Like a spring under a manhole cover. I said this recently at a conference and it got a few chuckles, but I'll say it again. We're going to see a religious experience in silver. Not because it's manipulated by some Illuminati cabal, but because 40 years of complacent algorithms are about to run into a third standard deviation anomaly. And when that happens, the leveraged players won't just lose money, they'll vaporize. And the broader financial system? Don't even get me started. Passive investing has become the new tulip mania. When you buy SPY or QQQ, you're not making a valuation judgment. You're making a momentum bet that everyone else keeps buying after you. It's the musical chairs model of finance. It works until the music stops. But here's the problem. Passive investing doesn't scale infinitely. When too much capital flows into index products, price discovery dies. Capital goes not to where it's most productive, but to where it's most represented. That's how we get zombie unicorns. That's how we get cash-burning tech firms trading at 40 times sales while profitable miners can't raise capital. Eventually, the pendulum swings. Valuation matters again. Free cash flow matters. Real assets matter. And that's where I think the next capital rotation will take place. Energy is another area I think is deeply misunderstood. I've been saying for a while that oil and gas are not going away. The narrative that we're all going to be driving Teslas powered by unicorn breath by 2030 is nonsense. Even under the most aggressive EV adoption curves, global oil demand doesn't peak until the mid-2030s. And by then, the underinvestment we've seen in upstream exploration will have hollowed out supply. That sets the stage for a spike, maybe even a super spike. The same applies to uranium. We've had a 10-year bear market, multiple mine closures, underfeeding from enrichers, and a political narrative that's finally warming up to nuclear. When the utilities come back to term contracting, and they're already sniffing around, the price doesn't go to $70. It goes to $150. And the spot market becomes irrelevant. You can apply that same framework to nickel, copper, tin. These are the inputs to the energy transition. If you believe in the Green New Deal, you have to be long commodities. There's no green future without red metal. So where does that leave us? In a world where fiat is being devalued, capital is being misallocated, and investors are being misled. You have to take responsibility for your own wealth. That starts with education. Read annual reports, study drill results, learn basic geology, understand bond math. Stop relying on pundits and start cultivating your own circle of competence. Because the opportunities are enormous, but so are the landmines. I'll leave you with this. The next 10 years won't look like the last 10. Passive won't work. Bonds won't work. Fiat won't hold. And ESG narratives won't hide bad economics. We're entering a period of revaluation, not just of assets, but of truths. Gold, silver, real energy, real businesses, and real skills will matter again. So get educated, get liquid, and get ready. Because as I like to say, in every crisis, there's a transfer of wealth. The only question is, will it transfer to you or away from you? That's your call.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.